Corporate finance practice problem using Excel. Stock dividend impact on equity and investor value. Get ready. It's time to take our chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. We have the information on the left-hand side. We're going to go through the calculations then in the blue area on the right-hand side. We're looking at a stock dividend, 10% stock dividend. That's going to have an impact on the equity section. So we'll be focusing in on the equity section. Remember that the equity section basically represents the owner's claim on a book value to the assets of the company as opposed to the debtor's claim. And there's not going to be an impact if you think about the balance sheet itself from the stock dividend to assets or liabilities, just a change to the equity section. So therefore, we would expect the ending equity to basically remain the same, something to be happening within then the equity section. So we'll see that. We'll come back to this in a second, analyze that equity section a bit more closely. We then have the stock market price. We're saying it's $14. The earnings at the $21,000, basically net income, bottom line of the income statement. The earnings per share at the 6, the price earnings ratio at 12. Note that the price earnings ratio should be at the 2.67 about. So you're gonna see that at the end of the presentation. It won't come into play at the end. When we do the calculations at that point in time, won't have an impact in the initial calculations for the statement of stockholders' equity. Stock dividend will be 10%, and the investor has shares, and we're going to say the original investor had shares of 200, and so we'll think about what the impact to that investor would be for this change as well. So let's first recalculate our statement of stockholders' equity, getting a feel for the statement of stockholders' equity. Remember, you want to think about the equity as a whole, representing the owner's claim. And of course, the owners are the shareholders, which we can then break out into the units. And therefore, we typically have these categories of the equity section, which includes, I'm going to just copy this over, the common stock, which is going to be equal to, I'm just going to pull over the same calculations, and then we will adjust those calculations with the calculations to the right, adding them in then to our stockholders' equity section after we have completed that. So we're going to take the shares. It's going to be the 4,000. 4,000's at the shares. The par value then is going to be equal to 5. I'm going to then recalculate this by underlining here, and that's going to give us our common stock, which is going to be equal to the 4,000 times the 5. Let's pull over the common stock. Let's do our indentation here by going to the alignment, indent it. I'm going to indent this one again, alignment and indent. Now remember that this represents the issuance of the common stocks from the corporations to the owners, which is in essence basically the investment of the owners into the company. Doesn't mean it's going to be the same owner, because they could then trade those stocks. So it might be a different owner that owns the stock at a later point in time than the original owner that invested the money, but this represents the investment from the shareholders. But there's a par value here, which is an arbitrary number, not the market price. It's not the amount that we issued for. It's just an arbitrary number that makes this number nice and even, because when we actually issue the stock, it's going to be at whatever price we can issue it for, and that might vary if we have multiple issuance over time. So that means that anything over and above is going to be in this paid in capital in excess of par, which is at the 5,000. That means that the 20 plus the 5 represents the owner's investment, as opposed to the earnings that have been generated, retained earnings, which have not yet been given out to the owners, distributed out in the form of dividends, and that here is the 28,000. Underlining that, font group and underline, that's going to give us our total equity. And that's going to be equal to the sum of the 20, the 5, and the 28. That's going to be our starting point at the 53,000. Now we're going to do our calculations to the right, and then we'll adjust these sections as we do these calculations, or once we are done with them. So let's think about the new shares that are going to be out there. We have the original shares. Let's call it the beginning. Beginning shares are at, I'm going to pull this from over on this side. Don't pull this 4,000, but this 4,000. Because we're going to change this one later, so we don't want to use that one in our calculation here. So we have the stock dividend then is at the 10%, 10% on the stock dividend. Let's make that a percent by going to the number group, percentifying it, font group, and underlining it. That's going to give us our new shares. New shares are going to be equal to the 4,000 times the 10%. We now have 400 new shares. So how many shares do we have total? Well, we have the beginning shares. In the beginning, there was nothing. No, we're not going that far back. We're going to 4,000 shares. In the beginning, there were 4,000 shares. Then the new shares we had were 400. 400 shares. We're then going to go to the font group and underline. That's going to give us the ending shares. Ending shares now after the stock dividend that we're going to have out there equals the SUM, the sum of the 4,000 and the 400. We're now at the 4,400 shares out there. Par value is going to remain the same. This is the difference between a stock dividend and a split of some kind because we're not changing the par value in the dividend. So we're going to then say underline here and do it as we say it. We're going to underline. We're going to actually underline as we say underline. Common stock, now ending value at the 4,400 times the 5. So once we get through all this, we're going to change that 4,000 here to 4,400. That'll change this automatically times the 5 to the 22,000. We're not going to do it yet. You could if you want, but I'm not going to do it yet until we're done. Then we know that there's going to be a distribution from the retained earnings for the value of the stock, which is valued currently at the price of the stock, which we're going to say is 14. So the other side of that is going to have to be an adjustment to, as we saw, the common stock and the paid in capital. So retained earnings is going to go down, which we'll do shortly. We already saw the impact on the common stock due to the new shares being out there. Now we'll take a look at the capital in excess of par adjustment. So that's going to look like this. We're going to have the stock market price is our starting point at the $14. Subtracting out then the par value. Par is going to be $5. So that underlining the 5, going to the font group and underlining, that then is going to give us the, I'll just call it the difference. Difference. Because we already took care of the 5 up top, so we're taking the difference between the market price and the par value. This will make sense more so, I believe, once we do the recap. So if it doesn't make perfect sense now, hang in there, hold on. It might be pulled together later. And so we're then going to say the new shares. We got the new shares out there at the 400. 400 new shares. And let's put an underline there. Font group and underline. And that's going to give us our change. We're going to call it change in the value. Let's say change in value. It's going to be equal to the 9 times $400, 3,600. Then we'll add that to the beginning balance. Beginning value in the capital in excess of par, which was $5,000. Underlining that, font group and underline, that's going to give us our ending capital in excess of par, which is going to be equal to the SUM, otherwise known as the sum of 3,600 and the 5,000. That gives us the 8,600. That's what this one's going to be. We're going to change this then to that number. Not yet. I'm not going to do it yet. You can do what you want to do, but I'm not going to do it yet till we're done. The other side is going to be going to the retained earnings. The retained earnings is going to be decreased in a similar way as we would with a cash dividend. Unlike with a split, a stock split, it will go down with the stock dividend in accordance with the value that we gave up, which we're going to say is that $12 here times the shares that were issued out. So let's calculate that. Retained earnings impact, which is going to be the other side, balancing ourselves out in the equity section. So we got the beginning balance. In the beginning, retained earnings started mysteriously with this substance of $28,000. And then we had new shares from the 10% stock split. New shares spontaneously grew from the stock split of $400. And we multiply that times the stock price. Stock price, which is $14, because that's the value of the new shares that we're issuing out from the company to the owners that are going out. It's not cash, but it's still a dividend. Valuable stuff here. This is valuable stuff. So we're going to decrease the earnings of the retained earnings by it. So the change in retained earnings then is going to be equal to the 4,000 times the $14 or the 5,600. So that gives us the ending retained earnings are now going down because we're not retaining these earnings. We're giving them out. 28,000 minus the 5,600. It's down to the 22,400 font group and underline. Okay, so now I'm going to change the equity section. So we're going to decrease it by the 22,400, taking into consideration the decline in the retaining of the earnings by the market price, because that's the value we're giving out times the number of shares. And then, so let's do that first. So we'll change that one. That changes that. But then we're out of balance because, we have to tie this out here. This has to be the same, and we're not changing assets or liabilities. So there has been no underlying really change, other than the equity section. So the other side then is going to be taken care of by the number of shares we know went up to 4,400. And we have to multiply that times the $5 because that's the par value. And so that takes it $5 of that 14 times the 400. The other, which is the 14 minus that $5, $9 times the 4,000, then is going to be the change to the paid in capital, which we did here. And that should get us back to the 53,000 right there. And it should make perfect sense now. At this point, everything makes perfect sense. Sense has been made once again. We're sense makers around here. We make sense of stuff. Okay, so now let's think about the earnings per share. So the earnings per share, if we had the earnings, picking up the earnings of the 21,000 on the earnings. And now we have the ending shares. So now we've got these shares, call it ending shares. I'll pick this up from the shares here. Are at the 4,400. Let's underline that, font group and underline. So that gives us our earnings per share of the 21,000 earnings, bottom line of the income statement, net income in essence. Number of shares now at the 4,400. We're going to go ahead and add some decimals. Number group decimalized, $4.77. So then what would the price be? Let's think about the price. So we're going to be using the price earnings ratio, which is given to us in the problem. Note that if you see this, something like the price earnings ratio, you might want to think about the ratio itself and then back into, say, the unknown, which in this case will be the price. Also note that this number did change in our data input, which we mentioned earlier in the presentation. So just realize that we're going to be picking up that 2.66 amount. So we're going to go to the number group, add a couple decimals. There we have it. Then we have the earnings per share. The earnings per share we calculated at the 4.77, $4.77. Adding decimal, number group, couple decimals, font group, and underline. That's going to give us then the price. The price, which we're going to calculate as the 2.67 times the 4.77, 13. Let's add a couple decimal, number group, couple decimals there. Let's think about the change to where the stockholder stands. The shares then at the beginning were 200 shares. We had 200 shares. The market price, we're going to say the stock market price was at 14. So we're going to say we started off at the 14 for the stock market price, which we are going to pick up here. Let's add a couple decimals to this 13 up top, number, couple decimals. 14, let's underline that, font group and underline. That's going to give us our, I'll just call it the total. That equals the 200 times the 14, or the 2,800. Then the change that happens, we say the beginning point, the beginning shares is going to be equal to the 200. There was a 10% stock split, so it should go up by 10%, or stock dividend. 1 plus the stock dividend is going to be equal to 1 or 100% plus the 10%. 1 or 100% plus the 10% gives us the 110%. Numbers, percent define it, 110, font group, underline. That'll give us the ending shares. We take the 200 times the 110%, giving us the 220. The price now at then the $12.73 we calculated. Number group, adding a couple decimals, font group, and underline. And that should then give us our investor value after the split, or after the dividend, let's call it. That's going to be equal to the 220 times the 12.73. We're at the 2,800 again. So, and that's what you would expect basically to happen, even though when you're looking at the market price, that's determined by the market. So you would think that given the fact that we had a stock dividend impacting just basically the number of shares, not having any other underlying impact in the assets or liabilities, should be reflected by the market, by in essence giving a value that you would expect to basically be the same at the end of the day.